Hi, everybody. My name is Max Friedrich. I'm a fintech analyst at ARK Invest. Together with Nishita Jain, I cover all things fintech, but especially digital wallets, which is the big idea for this year, and which we're going to take a closer look at right now. So we're going to lay out our thinking around digital wallets, what differentiates them from each other, but also from banks. We're going to compare them to banks. We'll come up with their total addressable market, their TAM, and then we're going to size the opportunity. So with that, we're going to jump into the first slide. But before getting to the content of the slide, let's first zoom out and think about what is a digital wallet. We define a digital wallet as an application on user's smartphone through which they can access different financial but other also commercial services such as e-commerce. We call them bank branches in users' pockets or handbags. They really first emerged in China with WeChat Pay and Alipay in the early 2010s, and since then have risen to billions of users, and you can really find them in all different geographies and markets around the world. The rise and dominance of digital wallets also is reflected in their dominance as a payment method, as you can see here in this chart. So on the left side, you see that on a global level, digital wallets are the #1 payment method for e-commerce purchases since around 2017. And since 2020, you can see that on the right side, they're also the #1 payment method for physical point of sale purchases. And we think that's likely as a result of the COVID-19 pandemic, which encouraged many people to shift their payments preferences from cash to digital. And this is a good moment to pause and quickly think about the COVID-19 pandemic and its impact on innovation, because that's a theme that really runs through this year's Big Ideas presentation. The COVID-19 pandemic accelerating innovation, and that certainly also is true for the fintech space and the digital wallet space. We think that the underlying shifts already were in place before the pandemic, the shift to digital payments, to commission-free investing platforms, but we think, again, they were really accelerated. And not only accelerated, we think they were cemented into consumer behavior and habits, not only in the form of short-term trends, but really long-term secular shifts. And there's a lot of empirical data to support this. So on a company level, most companies in the digital wallet and fintech space report higher user numbers, higher engagement numbers today than before the pandemic, and even relative to the height of the pandemic, which is pointing again to the lasting effect of these changes. There are also many examples from an industry perspective where, for example, in 2020, we saw a record number of bank branch closures. The bank branch closures net are up roughly 40% from 2020, which also was a record year. So other banks are also recognizing the shift from offline to digital. Talking about banks, and here we can jump to the next slide. We can talk about the interplay of banks and digital wallets here. Actually, on the first slide, the intro slide, the title of this presentation was Digital Wallets is Upending Traditional Banking. And we think that this slide and chart really speaks to that, right? So you have Square's Cash App, or now Block's Cash App, and PayPal's Venmo compared to JP Morgan users in the form of their deposit accounts, number of deposit accounts. And what you see is that over the last roughly 10 years, the Cash App and Venmo really have outgrown the number of deposit accounts at JP Morgan at a rapid pace. JP Morgan needed roughly 30 years and 5 acquisitions to reach roughly 60 million deposit accounts. And Cash App and Venmo, like I said, less than 10 years to go beyond that. Now, on a revenue per user level, traditional banks are still ahead of digital wallets, although we think that could change, and more on that later. But today, just looking at customer acquisition, digital wallets are clearly outcompeting banks. Customer acquisition and the customer acquisition strategies that digital wallets employ really are a central element to our thinking around digital wallets. It's not only relevant when comparing digital wallets to banks, but also when comparing digital wallets to other digital wallets or other fintech companies calling themselves digital wallets. And it's even more important it's become even more important over the last 2 years, as again, we saw this shift from digital, from physical to digital, and as a result, a lot of attention on digital wallets. So a lot of companies, investors jumped on the, let's say, digital wallet or super app sometimes bandwagon. So while we have researched and written about digital wallets for a number of years, we think that now with this increased attention, it's even more important to look at the details. And there is another kind of dynamic that adds to this, in our opinion, and that is that it's often, we think, difficult for traditional research departments to really understand and analyze and value digital wallets. An example of that is Brock's Cash App, which before the pandemic often was discounted or not really. The analysts were not really much interested in it. But as the COVID pandemic hit and Square's main business, the merchant payments business, was shut down because of the lockdowns, there was a lot of attention that shifted from the payments part to the consumer financial part of the company of Cash App. And we think the other investors in the industry is still kind of trying to figure out what to do with these digital wallets. So that being said, we think that not all digital wallets are created equal, and it's very important to go deep and differentiate between them. And like I said, a central vector here is the customer acquisition strategy. So as you can see on the chart, we have 4 different main customer acquisition strategies that we think about for digital wallets. The first one is P2P, peer-to-peer. Digital wallets acquire other users via peer-to-peer payments. This usually works well in markets where there's friction associated with payments, be it domestic payments or cross-border payments. And the digital wallets grow the user base organically via connections between the users, similar to how social media networks grow their user, right? So if you're the only person on Instagram or WhatsApp or another social network, that's not really valuable to you because you need other users to engage with, right? So you yourself have an incentive to bring on your friends and family to exchange with them. And the same is true, we think, for P2P payment digital wallets. And obviously in the US, you have the examples of Cash App and Venmo. You can look to other countries such as South Korea, where you have Toss, or you have Chipper Cash that is active across several countries in Africa. The second strategy is what we call land and expand. And the idea here is that the digital wallet perfects one single financial services use case that was previously not done well, was too expensive, too complicated, that was not accessible really for the majority of the population in a respective market. So they solve this financial services use case and then use the trust established with the users around that one use case to build a digital wallet out of that and attach more financial or commercial services. And a great example of that is Nubank in Brazil, which came out with a credit card a couple of years ago, a mass market credit card in a market, Brazil, where credit cards were only available to a small subset of the population. And then they used the trust established with their millions of users around the credit card to build other financial and commercial services around that. So now they have personal loans, debit cards, investing, e-commerce, and so forth. The third strategy we call vertical integration into financial services. The idea here is that you have non-financial services firm rolling out and cross-selling financial services to their existing, often very large user bases. So the prime examples of this would be WeChat Pay being built on top of WeChat, the messaging platform, or Alipay being built on top of Alibaba, the e-commerce platform. There are also other examples throughout Southeast Asia where you have digital wallets built on top of ride-hailing platforms such as Grab and Gojek. So we think these strategies work well in markets, in developing markets with low financial services penetration, where often users go literally from having no bank account at all to having a bank account with these non-financial services, often kind of big tech companies. So this works well in developing markets, but we think in developed markets, it's not an effective strategy. And we see this kind of play out. We saw Google discontinuing their banking account project with partner banks called Googleplex. Or also you can just look at Facebook, which had Messenger payments within the Messenger app activated for almost all of the 2010s, but you still had Cash App and Venmo building, these tens of millions of users. And very large user bases. So in developed markets, it's not enough to just sell somebody, a bank account or a debit card. You have to be more nuanced. You have to have a better customer acquisition strategy. And the last strategy is what we call merchant first, which is where a digital wallet not directly acquires a user, but uses merchants and cashback campaigns and other mechanisms to kind of use the merchants as distribution points to build a network of consumers. So why are these different strategies so important, and what do they actually mean in reality? Well, they yield, in our view, very, very low customer acquisition costs, especially compared to banks, but also compared to other digital wallets not deploying such differentiated, more nuanced customer acquisition strategies. So as you can see on the chart, in some geographies, digital wallets pay as little as $1 to acquire a customer, whereas banks in the US, on a net basis, spend $750 on a net new user in paid marketing expenses. Or if you actually include the occupancy expenses that they pay for branches and so forth, that number even goes up to $2,500. Why would we include the occupancy expenses in one of those calculations? Well, we think because bank branches in large part actually are a form of physical marketing outposts of banks. So if you drive past them, you see the logo, and banks will actually, in our view, use that to build a presence and build a consumer mindshare. Although now, as we discussed earlier, in a changing world towards digital, that probably, in our view, is not a good, not as an effective strategy anymore. So in short, we think low customer acquisition costs of these digital wallets gives them room to then invest and to move up market, and essentially puts them at a competitive advantage over, again, banks, but also other digital wallet or consumer finance companies that might not deploy these strategies. So with all that being said, let's now move to the more quantitative part, and let's think about the opportunity here. How can we quantify the digital wallet opportunity after so much is being said about them over the last 2 years? So again, if we assume that they become these dashboards for consumer for all things consumer finance and other commercial applications, we think each digital wallet user in the US could be worth $20,000 to $500,000 at maturity. That's really thinking about what is the value of all the different financial services relationships that the user has, and kind of the monetization that a company could scrape off that. So we do that by basically dividing the different financial services use cases into these categories that you see here: savings and spending account, payments, and so forth. And for each of those categories, we go in and we do the we go through a unit economic calculation. So we look at kind of how current companies in the market are monetizing these different services. And we also look at the TAM in those respective product categories, and we then estimate a revenue and an EBITDA, and essentially and finally back into an enterprise value for all these different categories. Again, at full penetration on a per user basis. So for example, for payments, we take common payment take rates and apply them to the average total retail spend per adult in the US, and back into, do the unit economics and back into the EV per user to estimate the maximum amount of value a digital wallet could extract from owning that part of a consumer's financial life. So in the case of payments, that would be that 100% of all the payments that a consumer does on a daily basis is flowing through that digital wallet. Now, this does not mean that we necessarily expect that 100% of digital wallet users around the world will only use that one digital wallet for 100% of their payments, but enables us to quantify this massive opportunity. And we do this exercise for all the categories you see in the chart. So now, having arrived at a per user opportunity, and really a way how to value that digital wallet opportunity on a per user level, we can translate this to a broader geographic context, and we could apply this to the US. So if we now know that at full penetration, a digital wallet user could be worth over $22,000. If we now assume that in 5 years, 100% of US smartphone users will use a digital wallet, and again, we'll see that 100% penetration, that puts the total digital wallet opportunity in the US at roughly $6 trillion. That is the total addressable market. That's the opportunity at maximum penetration, right? And now you can say, well, let's be more conservative and say, it's not 100% of smartphone users will have a digital wallet, but maybe only 75%, and they will be penetrated only by 25%. So the value creation is only going to be 25% of the 100% that's possible, and you would still, in our calculations, end up with a $1 trillion digital wallet opportunity, which is roughly double of what it is today at roughly over 400 billion. You can also translate this to the global context and kind of adjusting the potential value per digital wallet user from the US level to the global level. Again, you can say at full penetration, we're talking about a $20 trillion opportunity, which again is roughly equal to the market cap of financial services users, of financial services companies today. Now, this does not necessarily mean that we think that we're going to end up with 100% penetration here under all of these scenarios. And again, in our 2030 forecast, which Brett talked about earlier. So if you haven't checked out his segment, that was I think the first or second segment of the Big Ideas presentations. You should certainly check that out. We don't assume the full penetration for each and every digital wallet user. Hence, we estimate that by 2030, the attributable market cap of the digital wallets will be roughly around 9 trillion. But by assessing the digital wallet opportunity in this way, we can quantify the magnitude of it and the impact that it could, and to some extent, we think really likely will have, in our view, on the future of financial services.
This might soon be a thing of the past. Who needs cash when you can just as easily pay with an e-wallet? Worldwide, digital wallets on our smartphones are growing more and more popular. What systems are on the market? How do they differ from one another? And how safe are they? Our topic today on Shift. Most e-wallets come as smartphone apps. But there are biometric solutions too. Soon your own hand might replace your wallet. A scanner authorizes the payment, and that's it. Businesses are picking up on the trend and offering more e-wallet payment services. Facebook even announced its own app recently. But which one is right for me? That might depend on where you live and what you plan to use it for.
A bouquet of flowers without any cash? To many, it's already an ordinary part of daily life. E-wallets let users pay quickly and easily. There's a wide range of apps to choose from. You can get e-wallets through your bank. Then it's basically an extension of your regular account on your smartphone. Other e-wallets are connected to your mobile plan. They conduct transactions via text message. There is also a growing number of other providers, whether global players for worldwide payments like Google Pay or PayPal, or e-wallets for certain countries and currencies like Alipay in China or Paytm in India. The main principle stays the same. E-wallets are for storing money. The balance usually comes from a bank account or a credit card, or is topped up in cash. The app lets you pay by clicking a button, scanning a QR code, or with near-field communication.
I use e-wallets mostly because they're really convenient, because you can pay everywhere and anywhere with your mobile phone, and it takes away the hassle of dealing with cash or dealing with physical credit cards. With e-mobile payments, you can just scan a QR code and the money comes directly from your bank account.
Users should look out for fees, though. Often sending money to friends is free of charge, but many providers make a profit on other transactions. PayPal charges 5% on international money transfers, for instance. That can become costly in the long run.
So here's a checklist for finding the e-wallet that's best for your needs. What countries and currencies does it work in? How can I top it up? What payment options do I have? And what does the option I use most cost? And as always, it's also important to look out for your security and personal data. FinTech expert Julie Maupin has some basic advice for choosing the right provider.
Look for multiple factor authentication, look for making sure that there's backup practices, and make sure that they are warning you about how you should and shouldn't be interfacing with the technology.
Whether or not my money is safe depends on how I keep it. Leaving my wallet out is probably a bad idea. Using 1234 as a password for my e-wallet, also not the best. But providers need to maintain security standards too.
Technically speaking, most e-wallets by serious providers are well protected. The data is encrypted and stored on secure servers. It's recommended to use e-wallets which have been checked by at least 2 IT security companies. One risk remains: humans. Passwords need to be protected, and e-wallet users are a popular target for phishing attacks which enable criminals access to others' digital wallets.
This is the power and the danger of mobile banking. You are your own bank. And if you have bad security practices, you lose your phone or something happens, then you are the one who is going to suffer the consequences of that.
Like online banking, most e-wallets use two-factor authentication, for example, password and fingerprint. What if a transfer fails though? Some providers have accommodating rules similar to a bank. But that is not a given, for an e-wallet usually circumvents the middleman making a profit.
And if there is no longer an intermediary there who's making money off of you, then you have a danger that you're not going to get that charge back. There's nobody to charge it to send it back to you.
So e-wallets do come with some risks. But doesn't money always? How does mobile payment compare to other common methods? We took a closer look.
How secure is using an e-wallet compared to using a credit card online? The only way to answer that question is it depends. It depends on the e-wallet and on the online payment system. There are e-wallet systems that are more secure than some of the online payment systems that are in use today, and vice versa. I would prefer the e-wallet to using the credit card in the store because you've removed the human element. You don't have the cashier taking your credit card, potentially, copying it or memorizing it or whatever. An e-wallet is definitely more secure in the sense that you don't have to worry about physically keeping the cash with you all the time and having enough to pay. Every time I give my kids cash, they seem to lose some of it. For example, if they never lose their phones.
So when it comes to security, e-wallets make a good impression. But what about user data? Any electronic transaction leaves a digital footprint. When it comes to e-wallets, that information is not only available to my bank, but also to service providers like Google or PayPal. Are digital wallets just another step towards transparent customers?
I mean, cash has a certain anonymity to it that people like and that you don't quite have in the same way with digital currencies.
Digital transactions create footprints, which many e-wallet providers also use.
Data about payments absolutely is being used about you. Absolutely is a huge industry. People make lots of money by analyzing payment flows.
For many users, however, the advantages outweigh the risks.
All these private corporations know exactly what your spending behavior is like, what you are like as a shopper, your behavioral patterns essentially, and that might be uncomfortable for some people, but I personally, it's not a big issue. I would rather my transactions be tracked but safer rather than not tracked but not safe.
In the end, we need to choose what's most important to us. Fun fact, in Germany, we're huge fans of hard cash. Hardly anyone uses e-wallets here. Other European countries are less cash crazy. In Scandinavia, more people prefer mobile payment. And in many Asian countries, it has long become a part of daily life. China expects 500 million customers to use e-wallets in 2019. And it's no wonder. It's simpler, less expensive, and quicker than your classic bank. If I wanted to transfer money from my regular bank on a Friday afternoon, for example, I'll have to wait until Monday morning for it to be processed. When I use my e-wallet, the recipient instantly receives the money, along with a message that it has arrived. And the best part is, I don't always need a bank account for that.
The World Bank estimates that globally, about 1.7 billion people don't have access to a bank account. For them, e-wallets can enable access to the financial system. One example is the digital payment system M-Pesa. It started in 2007 in Kenya and is available in other African countries, in India and in parts of Eastern Europe. The account is linked to a mobile phone number. Users can pay bills or transfer money by text message. A large network of M-Pesa agents allows for the digital wallets to be topped up.
One of the interesting things about electronic wallets is that in places where the banking system is less developed, the least developed, you find the highest levels of comfort with using digital wallets, simply because people will grasp onto any alternative that works.
Banking the unbanked has come to Facebook's attention too. The planned e-wallet Calibra is supposed to be integrated into Facebook Messenger and WhatsApp. Users can then do worldwide payments in Facebook's own currency, Libra. The project has raised international criticism, but Facebook's entrance onto the strongly regulated financial market should give mobile payments another boost.
I think most likely in the next 5 years we will see big movements towards global e-wallet capabilities because of players like WeChat and Facebook and others with these massive platform reach pushing the sector forward. And as they sort of help break down the barriers with governments to get on board and allow this cross-jurisdictional use, country-to-country use of these kinds of currencies, it will become easier and easier.
Facebook's idea isn't necessarily new. E-wallets using cryptocurrencies like Bitcoin have been around for years. They encrypt transactions with blockchain technology, which makes them particularly safe.
Cryptocurrencies only exist digitally and are not regulated by any bank. The most well-known ones are Bitcoin, Ethereum, and Ripple. The term comes from the Greek word kryptos, meaning secret or hidden. It points toward the cryptographic encryption used for all components of the currency system. This technology is much safer than usual encryptions. All information, from balance to transaction, is secured in a blockchain, meaning in a cryptographically encrypted protocol. This way, user data is stored safely.
Depending on the type of cryptocurrency, some of them are fully anonymous and nobody can see your payment history. And that is a much more secure way of maintaining anonymity in payments. It could potentially be as secure or more secure than cash.
But this anonymity only comes with specific cryptocurrencies. The advantages of digital wallets are they're easy to use, they allow for quick transactions with a high level of security, at least when you follow basic data protection guidelines. One big disadvantage is the sensitive data you leave behind when you pay. How much money I spend on what and when is very interesting to businesses, and they're willing to pay huge amounts to know.